Good morning. It's Tuesday, the 9th of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital, now facing heavy rain in the last 2 days. Before we start the take, there are several decisions in polity and policy which are linked to data. Now, there are many instances of data in India once flowing smoothly and then stopping, and other instances where we appear not to be making any attempts to collect it. The biggest example, of course, is the census, which is now at least 3 years behind schedule, give or take 1 or 2 years for COVID-19, which in retrospect seems a little unnecessary, which is the concession, since we've managed to hold a bunch of state and central elections, all involving the mass mobilization of government machinery with fairly smooth outcomes. Most recent, of course, being the election, that is the parliamentary elections, results of which were out on the 4th of June. Now, the problem is that without a recent set of census figures, the debates around a host of issues, including population, diversity, demographics, incomes, start sounding increasingly hollow as different commentators lean on different data sets, which the other side quite evidently and obviously does not believe. That's actually quite sad for a country aspiring to be where we want to be. The latest data gap is gross goods and services tax collection figures. Now, the gap is glaring because no numbers were released June, at least officially that is, whereas for every month before that for some time, we've been quite literally screaming from the rooftops. The sudden disappearance of the announcement of these indirect tax collection numbers now leads to several questions, including whether something was off with the previous sets or something has gone so wrong now that the government is shy of releasing it. For June 2024, GST figures came in at about 174,000 crore rupees. That's 1.74 trillion rupees, a year-on-year increase of 7.7%, a little lower arguably than previous months. Now, Business Standard, which reported this, also pointed out in an editorial that this information was not made public this time through the usual press release with details, as has been standard practice. The headline tax collection number was disclosed to reporters informally this time, and it's also been reported that this would now be the norm in future. At a time when transparency and dissemination of timely information are becoming crucial, especially given India's intent to attract more global investment, discontinuing a practice that had become routine can be counterproductive, Business Standard says, and I concur. The problem is that GST is now used, since many other indicators are missing or not there or less trusted, as an important high-frequency indicator for a variety of stakeholders. GST figures are regularly tracked by many, including financial market analysts and investors. Given the official numbers, like the GDP data, which come with a significant lag, monthly GST collection numbers obviously give a broad sense of how the economy is doing. This is something we've discussed, by the way, in our earlier conversations, including with the team at CRISIL Ratings, who use now GST numbers to formulate more detailed expenditure patterns in the economy, including across states. Interestingly, one of the reported reasons for discontinuing the release is apparently the buoyant tax collection, according to Business Standard, which arguably gives an impression that the government is collecting too much tax. To be fair, the official reason for discontinuing the monthly release is not known, and I guess that makes it worse, but the level of tax collection cannot be the reason. This is Business Standard saying so. It is incorrect at various levels. First, gross GST collection is not for the center alone. It includes the share of the states. It also includes the compensation cess, which is used to repay the loans taken to compensate states for their revenue shortfall during the pandemic. The larger question, of course, just to come back, is the discontinuity in practice itself and the lack of reasons for doing so. Both are triggers for unnecessary speculation and, of course, a breakdown in trust. GST data, along with other pending data sets, which we will touch upon at a later date, must be released. Like in the case of monthly inflation numbers, they could, of course, be less fanfare. And our top stories and themes for the day. Citigroup says India will struggle to create more jobs. Goldman Sachs says all is well and will be better with the union budget on July 23rd. The stock markets are flat again as they search for direction now. The Chinese central bank has stopped buying gold. Could that slow prices? And why India Inc. must step up investments in and its contribution to nature-based climate solutions.
This is the Core Report with Govindraj Ethiraj.
Well, the markets are searching for direction. The benchmark Sensex and Nifty indices stayed in the negative zone on Monday, even as broader mid and small cap indices hit fresh record highs. The BSE Sensex was down about 36 points at 79,916. The NSE Nifty50 was down 3 points or 24,321. That's the closing number, clearly not moving much. The Sensex was down first and then up. The recovery was driven by stocks like Hindustan Unilever, Nestle and Reliance Industries, while stocks like Titan, HDFC Bank, TCS, Tata Steel, and Sun Pharma kept it down. The broader indices, which we just touched, hit all-time highs in intraday trade, though ended negatively as well. Meanwhile, the global markets were actually watching the action in the French elections. French stocks edged higher on Monday as markets reacted to a surprise win for the left in the country's parliamentary election. The CAC 40 erased earlier losses to trade higher, though this was off earlier highs. The euro was flat against the dollar, and trading in bond markets were also relatively muted, according to CNBC. So France's left-wing New Popular Front won the largest number of seats in this weekend's parliamentary elections, which in turn scuppered an expected surge for the far right, says CNBC. However, the coalition failed to secure an absolute majority, according to early data, leaving markets looking at the possibility of a hung parliament. China's central bank takes a breather. The Central Bank of China did not buy any gold for a second month in June as the precious metal was lower now from a record high. The Central Bank of China has been buying gold for 18 months non-stop. China, of course, is not the only country that has been buying gold. Countries like India and even Turkey have been buying too, and India has moved some of that gold back home as well, something that was widely reported. About 20 central banks still expect to raise their gold holdings in the coming year thanks to heightened geopolitical and financial risks, according to the World Gold Council report quoted by Bloomberg. Bullion held by the People's Bank of China was unchanged at about 73 million troy ounces at the end of last month, according to official data released on Sunday, quoted by Bloomberg. The central bank has obviously not opted to add to reserves in May, ending that 18-month buying spree, which also helped, by the way, push gold prices to its highest ever. So some analysts believe, this is the ones quoted in Bloomberg, that purchases will resume as the world's second biggest economy seeks to diversify its reserves and guard against currency depreciation. It's also possible on the flip side that high gold prices have deterred purchases. Gold has hit an all-time high above $2,400 an ounce in May, but then since edged lower as investors wound back bets, says Bloomberg. Not surprisingly, when the People's Bank of China published data on the May buying pause, gold suffered its biggest intraday fall in nearly 3 years. Of course, India too depends on what global gold prices are, and it would be interesting to see whether demand here is now set to pick up because prices are looking softer. The demand for gold in general is expected to stay strong. The Citi versus Goldman views. The government of India has issued a rebuttal to a recent Citigroup research note that had raised concerns over the pace of job creation. Money Control reports the government saying that the report, that's the Citigroup report, fails to account for the comprehensive and positive employment data available with official sources like the Periodic Labour Force Survey and the Reserve Bank of India's KLEMS data, according to the Ministry of Labour and Employment. Citigroup had said that India would struggle to create enough jobs for its growing population over the next decade, even if the country grew at a 7% growth rate, and suggested more concerted steps were needed to boost employment creation. Now, Citigroup's pronouncement, of course, sounded quite logical and intuitive. And the only problem with Citigroup, unlike other permanently bullish investment banks, is that it has said this publicly and evidently stirred a hornet's nest. Which also tells you that the one constituency that the government clearly seems to be listening to is overseas investment banks. It also tells you on the flip that no investment bank ever puts out questioning reports on anything, which, by the way, would be considered strange even in their home nations, which are, of course, the most prosperous nations in the world. Back to the employment numbers, the government has said that India has generated over 80 million opportunities between 2017-18 to 2021-22, which translates to an average of about 20 million jobs per year. Well, anyway, Citi's economists Samiran Chakrabarti and Bakar Zaidi had written in the report that based on a growth rate of 7%, India can only generate about 8 to 9 million jobs a year. Money Control also quotes the Labour Ministry saying that the EPFO and NPS data further backs this positive employment trend with manufacturing, services, infrastructure, and other emerging opportunities such as gig and platform economy and GCCs, that's the Global Capability Centers, showing robust future prospects. Now, there are some problems with this, which is that future prospects are not obviously past data. The second is gig and platform economy is not as big as we thought it would be, and if anything, are shrinking away. Anyway, the Labour Ministry also cautioned against selective use of private data sources that could lead to distortion about India's job scenario, which brings us back to the original problem. There are not enough data sources in this country. And the Reserve Bank of India also weighed in, saying India added about 47 million jobs in the year ended March, far exceeding numbers in private service, which is again a veiled dig at the Center for Monitoring Indian Economy, which pointed to high employment rates. I hope you're following all of this. Now, Reuters says that the report, a routine release from the Reserve Bank of India, has traditionally only shown historic numbers. On Monday, the central bank said it's attempting now a provisional estimate of productivity for the total economy for the first time of the financial year 23-24 based on available information. Well. Anyway, thank you, Citibank. India's total employment stood at about 643 million in 2023-24 versus about 596 million in the year before that, if I've got that right, according to Reserve Bank of India data, which would suggest that almost 46 million jobs were created in just 1 year. Could that be the case, or am I missing something? I'm not clear here, but I will come back to this. The central bank uses data from the government's National Accounts and Ministry of Labour to extrapolate the country's productivity and employment levels. The Centre for Monitoring Indian Economy, meanwhile, estimated the unemployment rate in India rising to 8% for last year from 7.5% and 7.7% in the preceding 2 years. For the month of May, the jobless rate, according to CMI, was 9.2%, the highest in 8 months, something we reported a couple of days ago. For those aged 20 to 24, the rate is more than 40%, according to CMI figures quoted in that money control report. The CMI, whose figures many people in business and economy that I know of, at least on the private side, trust, is now careful with what it says in public domain. Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. Goldman is back with the positive sign. So for all that not so good news about what employment levels really are and all the debates around that, Goldman Sachs says the upcoming budget on July 23rd is likely to stick to the path of fiscal consolidation, and they expect the Finance Minister Nirmala Sitharaman's budget to focus on the broad economic agenda rather than doling out minor stimulus measures. Now, this of course sounds like the broad hints delivered to friendly investment banks, of which Goldman, with its hyper-bullish reports, is surely one, by some officials close to the budget-making process. The report is obviously meant to, whether it actually happens or not, to keep the markets focused on the government's economic agenda and not be led to believe that the lack of an absolute majority for the BJP could cause or may cause a jump in social spending. Now, that jump in social spending was also projected to be a response to the electoral message interpreted by some as a vote against inflation, lack of jobs, and so on. Now, that is evidently not the interpretation of the government right now, so there we are. And the markets, going by the way we've risen after June 4th, the day the election results were declared, are clearly on the same side of the fence. Goldman Sachs said there was limited fiscal space to stimulate the economy given its high public debt, and that apart, India's infrastructure upgrades have created long-term positive growth spillovers, which they believe policymakers may not be willing to give up, which obviously makes sense. The Goldman Sachs chief Asia-Pacific economist and head of emerging market economic research said that the government would use the budget as an opportunity to make a big-picture statement about the long-term economic policy vision over the next several years rather than minor stimulus announcements. These are likely going to align with the government's development agenda for 2047, coinciding with the centennial of India's independence, said that report. India needs to step up on natural climate solutions. A survey of prominent Indian business leaders across 56 companies and 20 industries in India has come up with some interesting insights on how India's private sector is approaching the investments into natural climate solutions. More on what that means and how it plays out in a moment. The paper, titled Unlocking Private Sector Investment into Natural Climate Solutions in India, is led by the World Economic Forum and has partnered with the Confederation of Indian Industry, or CII, and environmental advisory firm IORA Ecological Solutions. The report argues that some $44 trillion of the global economy is at risk from nature loss. Natural climate solutions represent a strategy, or rather a key one, to address that dual crisis of climate change and biodiversity loss, as well as help strengthen the resilience of the world's socio-economic systems. Now, this in turn represents a range of actions to get down to basics aimed at safeguarding, conserving, restoring, and sustainably managing terrestrial, freshwater, coastal, and marine ecosystems while providing livelihood benefits, the report says. Focusing on India, it says the prolonged economic effects of climate change also risk increasing India's national poverty rate by 3.5% in 2040, equivalent to about 50 million more people living in poverty. With an estimated 30% of forest land in India considered degraded, the great majority of which is due to vegetation degradation, natural climate solutions are a comprehensive solution, providing benefits for ecology, people, and the planet by focusing on conservation and restoration efforts, according to that report. There is more on this, of course, and the big question is if and how the private sector is stepping up to the task. That's in India. I spoke with Zurich-based Nicole Schwab, the co-head of the Nature Positive pillar at the World Economic Forum, member of the executive committee. She also works on 1T.org, the World Economic Forum's Trillion Trees program, focusing on restoration and conservation of forest landscapes. I began by asking her to take us through the journey of this report from draft earlier in this year to the final one now.
So we launched a draft of this report in January, and the idea was to have a process whereby we could share the insights that we got in terms of private sector perspectives on investing in natural climate solutions in India. And we hosted a public-private roundtable in March with representatives from the Ministry of Environment and from a number of states to discuss those recommendations and really start that dialogue into how can the private sector increase its investments and its contributions in alignment with the government's priorities in this area.
And one of the findings, quite interestingly, in your draft report was the fact that it's public sector which is really investing more in this space right now and not so much private sector.
Yes, so we're now launching the final report next week. And as we see globally, about $200 billion are invested in nature-based solutions per year. This is only about 1/3 to 1/4 of what is needed if we're going to meet our global climate and nature targets. We know that we're facing a massive climate crisis. We have a crisis of ecosystem collapse, of nature loss, huge impacts across all sectors in terms of food, water, pollution. I mean, we know the crisis we're in, and yet we are only investing about 1/3 of what's needed, both globally and in India. And what's more, most of that investment is from the government. At the global level, only 18% is contributed by the private sector, and in India, that number is even lower. So what we know is that if we are really going to be able to meet the climate and nature crises that we're facing, we need to increase investment, and a lot of that investment will have to come from the private sector. And actually, there is a very strong business case because it is about resilience of businesses and it is about risk mitigation in terms of the environment we're facing in and to chart a course that is going to be sustainable.
Right. And which I guess is a good point to ask. So what does natural climate solutions or what do natural climate solutions mean in the context of business and the way they approach it, I guess, further in the context of their own ventures and manufacturing, installations and so on?
Yes. So natural climate solutions, we can say, are kind of a subset of what we call nature-based solutions, which is about protecting, managing, restoring our ecosystems. And we know that the economy is reliant upon a healthy environment. $44 trillion globally are at risk from nature loss. That's half of the global GDP. And more businesses are understanding their direct dependencies upon a healthy environment, whether it's the water that's being used. A lot of industrial facilities are relying on water, or whether it's topsoil that's absolutely critical for agriculture, or all the other benefits that we are receiving, so both for the economy and for society. So in that context, where there is an increased awareness that in order to have resilient economies and societies, we need to have healthy ecosystems, more and more businesses are starting to address that by understanding better how they can invest in nature-based solutions. And natural climate solutions means specifically also to target, the reductions that we can get in terms of CO2 emissions from investing in nature, specifically in forests. So to be more specific, we know that halting deforestation, investing in forests, reforestation, restoration, coastal ecosystems can play a very important role and contribute up to 1/3 of the abatement that's needed on the trajectory that we have towards a 2-degree planet as per the Paris agreements. So that's kind of, if you want to give you the bigger context and how different companies are positioning themselves within those bigger targets.
I'm going to come to some leading examples that come to your mind, both internationally and in India. But when we talk about reforestation or halting deforestation, it would imply that organizations or the manufacturing installations have control over much wider land space. So, or the broader or the external environment as well. Is that something that works out practically in many cases?
Yeah, so I think there's two parts to this question. So one is the direct impacts and dependencies that a business has in terms of nature. And as I said before, it can have to do with water, it can have to do with pollution. I mean, upstream watersheds. So restoring a watershed upstream can have a direct impact upon a downstream manufacturing plant, for example. And so even if the land that's in question is not directly under the private ownership, right? So I think this is where this concept of public goods comes in, and the importance of public-private partnerships, because it's only through this type of multi-stakeholder collaboration with the public sector, with communities, that we will be able to address some of these public goods. So in some cases, companies are working directly on their supply chains, and that's very much in the agricultural sector, and some companies that have very large land holdings where they can do what's called insetting. So let's say agroforestry in your coffee supply chain, right? So that can be a very direct measure. In other cases, and we can go into more example, it's going to be beyond the immediate business operations. And that will require a partnership, most often with government. I mean, we see in India, there's some very complex land ownership modalities as well. And this will require these collaborations to ensure that there is the investment and management of the ecosystems in those areas and restoration of forests, for example.
Right. And to pick up on some examples, what would, in your mind, be the best or good examples of companies which have done this, that is, implemented natural climate solutions in their immediate or external environments and are also a good beacon for others to look at?
Yeah, so I'll share 2 global examples, and then maybe we can also a couple of examples in India. So at the global level, if we're looking at within supply chains, for example, a company like Unilever or even Nestle are doing a lot on agroforestry. So they're working directly with their suppliers, with smallholder farmers, with local communities, and working on landscape conservation and restoration within those supply chains, on regenerative agriculture. So in the case of Unilever, for example, they're working a lot in Côte d'Ivoire, Indonesia, Malaysia, with different types of partners. And they have a commitment of protecting and regenerating 1.5 million hectares of land, forests, and oceans by 2030. So this is really a massive commitment. And some of that is going to be linked directly to their supply chains, and some of it is going to be beyond, again, with these principles of regenerative agriculture and working with suppliers. Another example where this is not in a supply chain because it's a different type of company is Salesforce. Salesforce has a commitment to help fund 100 million trees, conserved, restored, and grown by 2030. They've already invested in 52 million trees. So again, a massive commitment. And this is in combination with their target to cut emissions, right? So nature-based solutions are not a substitute. We need to do many things at once. And I think Salesforce is really also one of the leaders in this space of showing how you decarbonize on one side, but then also investing in restoration with a number of partners, be it through the purchase of carbon credits or through direct investment in projects. What's very interesting is they've set up a website where they're mapping all the projects that they're engaged in. So this goes from restoring high Andean forests in the Andes all the way to mangroves in Indonesia. So also very transparent, very interesting in terms of showing the progress and the monitoring of their work. If we go to a couple examples in India, all the respondents to our survey, so we had 55 companies responding among the Indian global companies, all of them are investing in nature at some scales, including restoration of degraded forests, wetlands, agroforestry, mangroves. And just to give a couple of examples, Vedanta, for example, They have a target of no net loss to biodiversity and working on conserving indigenous and ecologically sensitive species in Rajasthan. So that's one of their projects. They're also working, for example, on mangrove conservation and restoration in coastal areas around their operational units. And maybe another example that's probably quite well known is Godrej and Boyce. They've been conserving and restoring around 2,000 hectares of mangroves in Vikhroli in Mumbai over 6 decades now. And I've had a chance to visit, and I have to say it's quite a haven of fresh air and providing so many services to such an urban area. So I think it's also a very interesting example.
Right. So these are companies who've been doing it both globally and in India for a while, and for various reasons, maybe also being the fact that they're involved in products which are in some ways pulling from the natural ecosystem. Now, I'm guessing the report is also focusing on what's not being done and why that's not happening. So walk us through that.
Yes. So what's very interesting is the report shows that 90% of companies that we surveyed want to increase their investments in natural climate solutions over the next 5 years. So we have in a very short time frame. However, today, while most of them agree there's a business case for NCS investments, the funding for this is coming from CSR budgets, about 2/3, and 1/3 is coming for compliance reasons, right? So as to meet compliance measures. So there's a strong desire to ramp up investment. There's also a desire to engage in carbon credits. Yet there are a number of concerns and barriers that were mentioned. The first one is around regulatory clarity. So I think a lot of companies are very interested in the green credit scheme and kind of waiting also to see how that evolves and having a little bit more clarity on how they can participate in that and how that can facilitate some of these investments. A second point is what we touched upon before, related to public-private collaboration and kind of modalities in terms of the land ownership and what are some of the best practices where the private sector can participate with local communities, with the government, and really have this partnership to restore specific areas. And then the third area that was mentioned is around high-quality projects and monitoring and evaluation. So really ensuring that if they work with local partners, there are very robust monitoring and evaluation processes in place that allow the quality and, of course, the survival rate of the trees in case of restoration projects.
So if you were in the boardroom with the board of directors, including the CEO of one of these companies, what would you tell them today to do and why they should be doing this or moving faster on implementing some of these solutions?
Well, I would say to them that the future of their business depends on healthy ecosystems and on resilience in terms of our natural world. And that therefore investing now, first of all, understanding their impacts and their dependencies on nature is absolutely critical. I would tell them that regulation is coming in this area at the global level, whether it's the Task Force for Nature-Related Financial Disclosure or other measures. And I would say that to be ahead of the game, this is where you need to invest now, and it will benefit your employees, your brand, your resilience. It will benefit, the communities, and of course, our global community and global economy. And I would also say, so on one hand, there's a strong need to continue decarbonizing. So depending on the industry, for all of them, it's a priority, but it will be easier depending on which industry they're in. And in addition to that, it's fundamental that companies start to invest in restoration, afforestation project, restoration project, mangroves. We have a lot of examples, and we're starting to also lay out some blueprints. And this report and this dialogue that we started was also to start to facilitate that enabling environment in India so that companies have a lot of clarity in terms of what the options are available to them so they can make these investments now.
Right, Nicole, thank you so much for joining me.
Thank you very much.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.